Hey guys, RC Peck here with Thrills Wealth. So why is the stock market completely ignoring the economy, the unemployment numbers, the destruction, the pain, the horror that's happening really in the real world? And I want to approach it from three different positions. So the first is there are about 3,000 publicly traded companies in the United States. There's about 600,000 companies. So the publicly traded ones represent about 0.5%. Okay, now of the 0.5%, those 3,000, it's really about 30 of them that are doing really well. So that's 0.005% of all the companies. So just kind of think about that for a second. So you could replace the words the stock market with 30 publicly traded companies. And then that would start to help you go, oh, this is about just a handful of companies, not the stock market. So that's the first thing. Think of this as just about 30 companies. Now I have this price chart on because most of those companies in the top 30, when I mean most, like over 2/3 of them are some sort of technology based. They're using and leveraging technology to do well. Even a company like Walmart, which is in the top 10 biggest companies, the reason they're growing so well is for the third reason, which I haven't got to, but the first reason I'm talking about right now is they're one of the biggest and they have absolutely embraced technology. So what we have is a handful of companies and not a stock market. And those handful of companies are representing the majority of all the gains. Now, this is not the world's going to crash, the stock market's going to crash because it's only 10, 20, or 30 companies. This is just me answering. This is why the stock market, which now I think you can replace the word stock market with a handful of really big companies, okay? Even Johnson & Johnson, which is the 10th largest by market cap, okay? PayPal's in there too, almost a $250 billion company. Berkshire's in there, it's a conglomerate, all right? So we have these massive, massive companies, okay? So the first is it's no longer a stock market like we maybe thought in the 90s or the 80s or the 70s, but it's just a handful of companies right now that are representing these outsized gains, okay? The second thing is, so the first is it's not a stock market, it's a handful of companies. The second is the Fed, okay, which is this quasi-government agency. It's kind of under the management of Congress, meaning Congress can kind of make them do things. They have come out and they said, we're going to save those 3,000 publicly traded companies. We're going to save you guys and just you guys that 0.5%. And the way we're going to save you is by two things. We're going to buy your crappy debt, even if you should go out of business, and you can borrow from us at basically zero. So you can borrow at zero, okay, and we'll buy your crappy debt. So they're going out to those, just the top or those publicly traded companies, which is a 0.5%, saying, we're going to just protect you guys. Okay. Now, the other thing the Fed is doing is they've dropped rates to zero, essentially. Well, what this does is it takes a whole asset class kind of off the field, right? Because now, if you were to give the US government your money for 10 years, buy a US 10-year treasury, you'd get about $8,000 a year. Well, back in 2000, you'd get about $68,000 a year. So it's a huge difference what you could do with your safe money. So basically today, your safe money is not going to do anything for you, which is going to drive people into the stock market. And the majority of that driven money is going to go to those 30 biggest companies. So it's kind of this circular loop here. And then the third reason why the stock market is ignoring the economy, it's because it can. And what has happened is COVID has created this situation where we have to stay at home. And so the companies that are doing the best are companies that can actually thrive and grow while the world stays at home. So you have the blue line is technology, just kind of showing you how those stay-at-home companies, stuck-at-home companies have done, up about 31% for the year. The S&P's up about, or the total stock market index, this is all the stocks, publicly traded stocks in the US, up about 8%. So a pretty significant difference between those top stuck-at-home stocks and the rest of the country. The other thing I actually wanted to quickly show on here too, before I go to the other ones, is this is the yield of the 10-year treasury. It's hard to read this, but because it's a logarithmic scale, so you really can't tell. Actually, let me just change this and just show you kind of what we're looking at. This is not much better. But basically, that's showing you that if you give the government $1 million every year, they'll give you about $8,000 back, compared to 20 years ago where they were giving you $65,000 to $70,000 a year. Pretty dramatic. Okay, so the question is, why isn't inflation skyrocketing? And this is why. Okay, people aren't spending their money. This is called velocity of money. As you can see, it has plummeted. It is exceptionally difficult to get inflation, regardless of how much money is printed. If this number right here keeps falling, and you can see it's fallen off a cliff. So it's going to be very, very, very difficult to get inflation when the velocity of money is tanking. Okay, and then I guess the last reason that there's this disparity going on between the stock market, right, and the economy is this. I pulled this tweet off, and let me just read it to you. There's two tweets that came out within the same 30 minutes of each other. Bloomberg says initial jobless claims fell to 837,000 people last week as fewer Americans than expected sought unemployment benefits. So initial jobless claims fell last week. Okay. Then there's breaking news from Wall Street Journal. Filings for jobless benefits held steady at 837,000 for the fifth straight week, reflecting a labor market recovery that is losing some momentum. So one is saying something positive and one is saying something negative. Okay, it may not be the best example, but what you have is Bloomberg and Wall Street Journal saying 837,000 good, 837,000 bad, right? This goes to the more you're reading news, the more you're going to be angry. And I know this because all the algorithms on all the biggest platforms have figured out that if they can anger you and if they can trigger you, you're going to click more things. You're going to spend more money. So just by default, the algorithms of all the major platforms, including TV channels, okay, they've figured out that an enraged viewer is worth more to them. And guess what can enrage people? Talking about how the economy is doing so bad and how the stock market is doing so good. And then lastly, and I'll wrap this up, about 10% of people own the stock market. That's it. It's about 10% worldwide. Okay. The income of the top 10%. So if you're in the top 10%, you're making over about $140,000 a year. Right. So also think about that. Everyone making over household $140,000 a year, most likely those are going to be more white collar jobs, more jobs that are protected by larger corporations. So that top 10% of people, they have more protected income, they have more protected wages, and they basically own the stock market. So they're going to continue investing in the stock market, even though the bottom 90% are absolutely getting crushed and either are in a recession or are in a depression. So the disparity between the top 10% and the rest of the world is actually accelerating in the opposite direction. So that's the why, right? That's the why the stock market is ignoring the economy. And the shortest and maybe horrible answer is it's because it can, and it was designed that way, and the Fed's helping it, and the incomes and the stuck-at-home stocks and all those things together are creating a stock market that in many ways doesn't really care about what's happening to, the bottom 90%. Sounds weird to say the bottom, but the bottom 90% of the market. So I hope that makes sense, guys. Thanks for being here, and I look forward to seeing you on the next video. Okay, thanks, guys. Bye. Hey guys, if you like this, you're gonna love the 3 mistakes video because it shows you exactly what mistake you are making if you don't have the growth and income you want. Go ahead and click and I'll show you immediately.